Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Spyre Therapeutics Inc. annual report. Spyre Therapeutics, a clinical stage biotechnology company, specializes in developing therapeutics for patients with inflammatory bowel disease, IBD, and rheumatic diseases. The company's pipeline includes several promising treatments that target specific proteins involved in the inflammation process. One of its lead candidates is Spyre, a humanized monoclonal antibody designed to treat IBD by binding selectively to the A4-sharp-7 integrin. Additionally, Spyre Therapeutics is developing two anti-TL1A MAbs, Spyre and Spyre, which target tumor necrosis factor-like ligand 1A, TL1A. The company's pipeline also includes Spyre, a clinical stage program that targets interleukin-23, L-23. Furthermore, Spyre Therapeutics is working on several combination therapies. These include Spyre120, a combination of anti-4-sharp-7 and anti-TL1A MAbs, Spyre130, a combination of anti-4-sharp-7 and anti-L-23 MAbs, and Spyre130, a combination of anti-TL1A and anti-L-23 MAbs. These treatments aim to provide more effective relief for patients with IBD and rheumatic diseases. In summary, Spyre Therapeutics is providing the following businesses and services: developing therapeutics for inflammatory bowel disease, IBD, and rheumatic diseases, creating humanized monoclonal antibodies that target specific proteins involved in inflammation, designing combination therapies to provide more effective relief for patients with IBD and rheumatic diseases. The stock price of Spyre Therapeutics, Inc., SYRE, has skyrocketed by over 103.25% in the past year, reaching a 52-week high of $42.93 on February 20, 2026. This remarkable surge can be attributed to several key news events that have fostered investor confidence and optimism about the company's immunotherapy pipeline. One of the primary drivers of this growth is Spyre Therapeutics' positive Q4 earnings report, which narrowly beat FactSet estimates despite showing a loss per share. The company's effective cash management, strategies, and robust cash position of $756.5 million have also contributed to investor confidence. Additionally, the presentation of differentiated clinical data for its anti-L-23 antibody, Spyre, at the 21st ECCO Congress has highlighted the potential of this treatment. The acceleration of clinical trial timelines for Spyre Therapeutics' inflammatory bowel disease, IBD, treatments has also been a significant factor in the company's stock price increase. The completion of enrollment for its Spyre antibody in the Skyline platform trial ahead of schedule has allowed PARTA readouts to commence earlier than anticipated, with 6 proof-of-concept readouts expected across its pipeline by 2026. Furthermore, favorable analyst ratings and price target increases have further bolstered positive momentum for Spyre Therapeutics. Multiple financial firms, including Mizuho, Jones Trading, and BTIG Research, have issued positive ratings and raised price targets, citing the potential of the company's anti-TL1A portfolio and the confirmed significant half-life of Spyre. The reduction in short interest has also contributed to the company's stock price increase. A decline of 13.5% in short interest in January 2026, falling to approximately 10.07 million shares, 13.8% of float, has signaled a decrease in bearish sentiment and further bolstered positive momentum for Spyre Therapeutics. Overall, these combined developments have significantly contributed to the substantial increase in Spyre Therapeutics' stock price, making it an attractive investment opportunity for investors seeking growth in the biotechnology sector. Spyre Therapeutics, Inc. maintains a market capitalization of $3 billion, broadly in line with the industry peer group. Spyre Therapeutics, Inc. trades at a higher price-to-book ratio of 6.04 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 15% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This also raised the question if that management is diluting shareholders to sustain the business. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. If the business does not improve its revenue and generate positive cash flow, the company will continue to struggle to cover its cost and interest expenses. This combination makes the investment case highly unfavorable unless earning issue is addressed. On top of the cash-burning business, shareholders are consistently diluted. I may be wrong, but I would suggest to stay away from such investment for now. The primary drivers of revenue growth for a company can be attributed to several key factors. Regulatory approvals for product candidates are crucial in driving revenue growth as they enable companies to bring new products to market. Successful commercialization of these products also plays a significant role in generating revenue. Additionally, milestone payments from agreements and royalties on net sales of certain products contribute to revenue growth. On the other hand, revenue decline can be attributed to several factors. Failure to raise additional capital when needed can lead to a decline in revenue, as companies may struggle to fund their operations. Inability to generate revenue from product sales is another significant factor contributing to revenue decline. Furthermore, significant losses for the foreseeable future and disposal of property and equipment resulting in a loss also contribute to revenue decline. Other factors that can impact revenue growth or decline include compliance costs related to environmental, health, and safety laws and regulations, adverse legislative or regulatory tax changes, failure to realize benefits from acquisitions or strategic alliances, and delays or failures in integrating acquired businesses or products into existing operations. The company's debt level has undergone a significant reduction over the past year. As per the extracted summaries, the total debt decreased from $90,680 in 2024 to $62,545 in 2025, indicating a substantial decrease of approximately $28,135. Furthermore, the non-current CVR liability also saw a notable decline, dropping from $36,620 in 2024 to $3,860 in 2025. The reduction in debt level is also reflected in the CVR liability, which decreased from $61,700,000 as of December 31, 2024 to $26,680 as of December 31, 2025. This significant decrease in debt level suggests that the company has made considerable progress in managing its liabilities. On the other hand, there are no notable changes mentioned in the summaries regarding interest expenses. Despite the substantial reduction in debt levels, it appears that the company's interest expenses have remained relatively stable over the past year. The management of the company is optimistic about its financial situation, with a strong financing position and sufficient cash reserves. However, they acknowledge that conducting clinical research is costly and time-consuming, and regulatory approval is uncertain. As a result, the company has initiated a process to explore strategic alternatives to maximize stockholder value. In terms of revenue recognition, the management emphasizes that it will depend on the transfer of control of promised goods and services to the customer. They also highlight the uncertainty surrounding tax positions and the potential impact on future cash flows due to managing available-for-sale debt securities. The company's strategy is focused on managing its financial situation while advancing its research and development efforts. However, the inconclusive interim results from the Phase 1/2 clinical trial have led management to explore strategic alternatives to maximize stockholder value. Overall, the company's outlook and strategy are centered around managing risks, including market risks, credit risk, liquidity risk, operational risk, regulatory risk, and cybersecurity risk. Management is confident in its ability to manage these risks and believes that its exposure to market risks is not significant due to the majority of its investments being short-term in duration and having a low-risk profile. The company's outlook and strategy are focused on long-term growth and maximizing stockholder value while navigating the challenges associated with conducting clinical research. The company has made several strategic moves through acquisitions and divestitures to shape its business landscape. In terms of acquisitions, the company has expanded its capabilities by acquiring pre-merger Spyre on June 22, 2023. Additionally, it has acquired certain intellectual property rights related to research programs from Paragon, entering into license agreements for specific assets. This move is expected to enhance the company's research and development efforts. On the other hand, the company has divested some of its assets to optimize its operations. Notably, it sold global rights to pegsilarginase to America in July 2023, receiving $15 million upfront and up to $100 million in contingent milestone payments. Furthermore, the company abandoned leased corporate headquarters and laboratory space in Austin, Texas, recognizing a loss of $0.9 million and paying a termination fee of $2 million. These strategic moves demonstrate the company's commitment to growth through targeted acquisitions and optimization of its operations through divestitures. The company's financial activities have been focused on share buybacks rather than dividend payments. According to the extracted summaries, there are 2 instances where shares were bought back through private placements and an underwritten public offering in 2023 and 2025, respectively. Additionally, restructuring charges led to cash payments for employee-related restructuring charges, which also resulted in a share buyback. In contrast, there is no clear indication that the company has paid dividends to its shareholders. Concerns about inventory buildup and supply chain disruption are prevalent in various aspects of biopharmaceutical production. One major concern is the potential for minor deviations from normal manufacturing processes to lead to reduced production yields, lot failures, product defects, and supply disruptions, page 61. This can result in extended facility closures for investigation and remediation. Furthermore, supply chain disruption due to tariffs and countermeasures poses a significant threat, pages 62 and 77. The unpredictable nature of trade policies, such as the BIOSECURE Act and U.S. legislation, creates uncertainty in global supply chains. Additionally, direct tariffs on pharmaceutical products can lead to increased costs and reduced ability to source critical contract manufacturers, page 79. The reliability of third-party service providers is also a concern, with compromised infrastructure or supply chain disruptions affecting biopharmaceutical companies, pages 81. These concerns highlight the need for careful management and mitigation strategies to ensure continuity in production and delivery. That concludes the financial summary for Spyre Therapeutics Inc. Feel free to comment below, and I will be happy to answer them when possible.